So joining me now with where he's putting his money is Paul Christopher, head of global investment strategy over at Wells Fargo Investment Institute. Paul, thank you very much for being here with us. Let's take us,
Hi, Dom.
please just take us through what exactly you mean when you say that you are out of some of these AI names into other parts of the market, but you still believe in the AI trade.
Well, yeah, that's the fundamental premise, is that we think there are years left to go as AI and other technology developments continue to evolve. Cybersecurity would be one. Digital assets would be another one. We already have some automation in the economy. We think that expands quite a bit more. And artificial intelligence could be an adjunct, could be a helper for all of these other technologies, in addition to standing alone by itself in helping people in their daily lives. So we think there's further trend to go. We're still in the early innings, but because we're in the early innings, there's a likely tendency for markets to get a little bit extended at times. And so in August, we pulled back on communication services. We thought it had gotten a little extended. We rotated that money where? Well, we want to put it in some place that's an ancillary trend to technology, but maybe isn't quite so highly valued. So, for example, utilities with a PE of 20 compared to mid-30s for IT, information technology, and comm services. And then at the end of October, we pulled back on information technology as well. The same idea. It looked like it was getting extended, so we go to look for an ancillary trend. In this case, we took emerging markets. Think about a Korea, think about a Taiwan, chip manufacturers, hardware manufacturers. We think that is going to be another way for investors to play the longer-term theme, but without maybe that short-term overexposure.
Now, all of those places are filled with certain parts of those sectors or industries on a relative overvalue versus undervalue basis. So how exactly then do investors play it? Do they try to go after the fundamental stories that are undervalued in those places, or do they just buy an ETF or mutual fund that tracks some of those trends?
I mean, if you want to do the due diligence, yes, that would be the best way, would be to go and kind of dive deeper. But our feeling is that these sectors are going to become more and more dominant in these other countries, just like they have become in the U.S. over the last 10 to 20, even 30 years. Tech has become a larger and larger share of the S&P 500. So going forward, a small allocation to a broad-based basket of emerging markets could be a good and diversified way to play those markets in addition to what you have here in the U.S.
All right. The tech and comm services trade is something that we've talked a lot about. Other parts of the value chain, in terms of the sectors in the market, are also getting more attention these days. We've seen the huge run-up in healthcare stocks over the course of the last few months. Are there other parts of the market that you think are overweight ratings versus what we see in tech and comm services?
Yeah, we would be trimming. What you've seen happening is, what you're describing is actually a rotation. It's been a rotation away from technology and into some defensives. So some of those consumer stocks have made it to the top of the performance rankings over the last 6 to 8 weeks. Healthcare, which is one you mentioned, we would be fading those consumer stocks and taking the healthcare back to market weight, and then using that money and rotating that once more into the areas that we tend to favor. Again, utilities, well, we like those. We like industrials. We like financials right now.
What about the financials trade makes them attractive to you, given where we are with the interest rate cycle, the expectation of rate cuts coming up? How exactly do financials fare in 2026, given that backdrop?
Yeah, that's a good question. So a couple of different angles on financials. First of all, if you're looking for some diversification away from a little bit not quite so centered on technology, you could do financials because, look, we think the interest rate on the short end of the maturity spectrum, the yield curve, we think those rates come down some more. Meanwhile, the rates on the longer end of the maturity spectrum, those 10s, 20s, and 30s, we think those yields stay firm or even rise a little bit. That would favor banks, right? Because the bank is going to pay you the deposit rate. That's the short-term rate. That rate is falling. Their costs are falling. At the same time, the longer-term rates, that's what they lend at. That generates their revenue. Those rates are steady to higher. So that's one way to play, or one way to think about financials. But another way to think about it, and again, this touches a little bit on, but it's not entirely centered on technology, and that is that these technology companies increasingly are expanding via debt. And so we think that's maybe an interesting way to think about the financials as well. So it's got a foot in there, but not both feet into the technology trade. It gives you a little bit of diversification in an economy that we think is going to improve with falling short-term rates.